Hey, what's up everybody? Today we're going to do a very basic introductory lesson to accounting. There's a couple of reasons why I want to do this lesson, and I have my kids here to help me do this lesson. Now, the first reason is because accounting is the language of business, okay? If you don't understand your numbers, the balance sheet, the income statement, then you really don't understand your business. You have no clue if your business is succeeding or failing. And I don't mean that you have to be an expert accountant, but you need to understand the basics. The second reason is because in my practice, I see over and over again. In fact, it's very rare that I see someone come in with a QuickBooks file that is accurate. Now, it may not be completely off, but I almost never see an accurate QuickBooks file where the balance sheet and the income statement are correct. Now, that might shock you. I love QuickBooks. I think it's a fantastic tool to use, but it makes things almost too simple. And what I mean by that is you can be plugging away, entering in your expenses, your checks, your deposits, your invoices, and you might think at the surface level that everything is accurate, but the accounting behind the scenes could be slightly wrong, or in some cases it could be very, very significantly incorrect, and you not know it at that surface level because of the way that the program works. Now again, it's a fantastic tool. I put all small businesses on it that I work with because I love it. But if the underlying accounting isn't happening correctly, you don't have accurate reports. And I see that time and time again. And so I want to help you understand this. So this is going to be a playlist or a series of videos where we walk through some basic accounting concepts and then also how those things interact. What happens behind the scenes when you enter a check or an expense, when you enter a credit card payment or a deposit or an invoice into QuickBooks. We're going to look at this so that you have a good understanding of this. All right, let's jump in. All right, guys, what we're going to do is we're going to walk through very basic accounting concepts. And my thought is, if I can get my kids to understand it, hopefully you can understand it. All right? Now, do you guys know what any of this means?
No.
We got a balance sheet, we got an income statement. You know what one of those things means up there?
I know equity is.
What's equity?
It's like the percentage of a business that you get.
Percentage of a business that you get. Sort of, that's a very good way to put it.
Like the percentage of the business that you own.
That could be true. So if you own 20% equity in a business, that's how much you own. So that means that equity is the value of the business. That's how much you actually own. What do you think an asset is?
I don't know.
Don't know. Anyone know what an asset is?
Yeah.
What?
Something that you need for the business.
Something you need or own for the business. What's a liability?
Something that is recommended or mandatory for the business.
Not quite. So a liability is something you owe someone else. So this is something you own, something you owe to somebody else, and then the equity is actually how much you truly own in the business. Now on the income statement side, what do you think the income statement shows? Not sure? Income statement shows your income or revenue minus your expenses is your net income or net loss if you have a business that's not making money and is losing money.
Wait, is your net income like the money that you net, how much you get?
That's how much you net at the end of the day, how much is left over after all of your expenses for you to take and use personally. All right, so the income statement and the balance sheet also interact with each other even though they're separate statements. We're going to cover that, I think, in this video a little bit as well. All right, we're going to use, these guys use Rooster Money for an app. So what do you think in Rooster Money? How much E do you have right now in Rooster Money?
I have no idea.
What's a random guess? Rough estimate.
I had like 24.
24, okay. So
Except that we bought something.
that's okay. We'll say that you have 24 right now. Okay? So you have $24 in Rooster Money. That's how much you have. That's an asset. You own that. Now, how much do you owe someone else right now? Do you owe anyone else any money?
No.
No. Okay. For the sake of this, let's pretend that you owe me $4. You came to me and said, I need an extra $4 because I don't quite have enough to buy this toy. Would you lend it to me? And I lend you $4, but you got to pay it back to me, okay?
Right.
That is a liability. You owe me $4. Now your balance sheet is assets minus liabilities equal equity. So how much equity do you have?
So 24%, 20%.
These aren't percents, these are dollars.
$20.
$20.
Okay.
All right. So you have $24, but do you really have $24?
No.
No, because you owe someone else $4. So you actually only have 20. That's the equity in the business.
Right.
Balance sheet is a snapshot, a picture of your financial situation at one point in time. So right now, you might have $24 in the bank, owe someone else $4, and so your equity is $20. Okay, right?
Okay, so
Now, that might not be true tomorrow, because if you spend $1 tomorrow, this isn't going to be true, right? That's going to go down by $1.
Right.
Okay, so let's say that's where you're at a point in time. The income statement, this is your income and expenses over a period of time. So that period of time could be 1 day, or it could be a year, or it could be 3 years, or it could be 6 months. Okay, so what's going to happen? What do you want to do with that $24 in Rooster money? You're going to buy something. You want to buy a toy? Okay, how much is the toy you're going to buy?
$50.
Well, you don't have $50.
$20.
All right, let's say $10, okay?
Okay, 10.
Well, first, you get an allowance. How'd you get that $24 over there? You get an allowance?
Mm-hmm.
So let's say that you get $10 as allowance. That's income. That's money coming into you. I'm going to give you $10 as an allowance. You're going to spend $5. Okay? What's your net income? If you got $10 and you spent $5, what's your net income?
$5.
$5. You have $5 left over after you spent it. Okay? That's your revenue minus your expenses equals your net income. Assets minus liabilities equals equity. All right. That's your balance sheet and your income statement. Okay? This one tells you how much money you have. This one tells you what you made, what you spent, and how much money you made. Right? Now, how do these two interact with each other?
I don't know.
You don't know.
Because maybe because you start with a certain amount of money, but you spend a different certain amount of money, and then you end up with a different amount of money.
That's kind of true. That works. So again, the balance sheet is as of a point in time. The equity is going to be broken down into two numbers. Now, in this particular situation, those two numbers have to be a specific amount because of what we've put on the board as our assumptions. The equity is going to be broken down into retained earnings. What does it mean if you retain something?
I don't know.
You keep it. Is that what you're going to say?
I was going to say to sturdy, to make it like sturdy.
Oh yeah, you can make it sturdy. This way, retain means to keep. So you're keeping your earnings. Your earnings. Retained earnings plus the current year net income. So let's say this happened last year. This was last year. And now we're going into the next year. At the end of the year, if we keep this $5, it becomes retained earnings.
Uh-huh.
But during the current year, that $5 is net income of the current year. So in this particular situation, if we currently have $5 of net income, our retained earnings from prior year has to be what amount?
$5.
No, not 5.
20?
Not 20.
10.
Not 10.
50.
These two have to equal that number.
10. Oh, 15. Wait, no, 15.
15, yeah.
15.
So, in a previous year, we made $15 or multiple years because this retained earnings can be over multiple years. That's money that was left in the company, becomes retained earnings. At the current year, net income is 5. So our retained earnings plus our current year net income is $20. So this all still balances. All right. Now let's say right now this is what our balance sheet and income statement looks like, and you want to go buy another toy. You're going to spend another $5. Okay? Ready? What's going to happen to your assets? Your $24 if you spend 5.
You're going to have 19.
You're going to have $19 here. Your liabilities. Anything going to change there?
No.
Okay, we're still going to have $4 there. What's 19 minus 4?
15.
15.
15.
All right, so that equals 15 now. Well, 15 plus 5 is still 20. But now we're down to 15, not 20. Did this 15 change?
No.
That's earnings from a previous year, right?
Mm-hmm.
That pretty much stays the same. So 15 plus what is 15?
Zero.
Okay, so if our retained earnings are 15, our net income for the current year is 0. Let's make sure that that actually works. Well, we have 10 of revenue, we had 5 of expenses, we have 5 of net income. Did you get any more money?
No.
Did you spend any more money?
Yes.
You spent another $5, so now our expenses are 10. 10 minus 10 is 0.
Mm-hmm. Yeah, so it works.
So net income flows to the balance sheet under what section of the balance sheet?
Equity.
Equity, right?
Yeah.
Now what happened, the last thing we're going to cover in this video is what happened with that transaction and where were the entries made in the accounting system, okay? Now we're not going to cover debits and credits. Those terms we'll explain in another video because they really confuse people because you're thinking about normal debits and credits in a bank account or a credit card account. They have a different meaning for accounting purposes, so we're not going to cover that in this video. But here, all right, during this transaction, the beauty of an accounting system is it's called double entry accounting. That means that anytime you change one account, you must change at least one more account. The transaction must balance, okay? So it has to be equal on both sides of the transaction. So we're going to show 2 examples of how it can be equal on both sides of the transactions. So with this one, you spent $5. So we made an entry to your cash asset of $5. But that's only one side of the transaction. Where was the other side of the transaction? And how much does the other piece have to be for them to be equal? This side was $5. We reduced cash by 5.
So the other side has to be $19?
No. We're just looking at the transaction itself. One side is 5. The other side has to equal the same amount. 5. So where did we put the other $5 to make this transaction 5 and 5?
In the income statement?
We did, and we put it in expenses, right? So this $5 reduced our income, and this $5 increased our expenses. Now, debits and credits will come into play later, but not right now. We'll explain that in a later video. But $5 on this side and $5 on this side is a balanced transaction. Right?
Yep.
Now, let's say you borrow. This is our second transaction of another way an entry, an accounting entry, also called a journal entry, can balance. You need to borrow more money from me. How much do you want to borrow?
$5.
You're going to borrow another, let's borrow $50. All right? Now, if you borrow $50 from me, and I give you $50, where's that $50 going to go?
Into assets.
It's going to increase the amount of cash you have.
So that's going to be 60.
So if we have $50 on one side of this transaction, what has to be on the other side of the transaction?
69.
50. It's got to be 50 and 50. All right? So $50 on that side. Where's the other 50 going to go?
Under expenses.
Under expenses. Did you spend the money?
Oh, no, under revenue.
Under revenue. Did you make the money? Is it income to you?
No.
No. What is it?
It's revenue. Assets.
Eli's got it. What is it?
Liability.
It's a liability.
Oh.
50 here. Makes that 54. Now what's 69 minus 54? It's still 15. So this stays the same. These change. So the transaction balanced because 50 increased this. You borrowed it, so it increased your liabilities. Transaction was balanced. Everything still equals the same amount. Assets minus liabilities still equals equity.
Yeah.
Retained earnings plus current year net income still equals the income statement. That happened last time too.
Huh.
All right, very last thing. that two sides of the transaction, they have to be equal, but they don't always have to just be two numbers. All right? Let's think of another transaction. Okay, I got another transaction. Let's say you sell a toy to a friend for $5,
Right.
and I loan you $5, and you go make a deposit at the bank. You take both of the $5. How much are you depositing?
10.
You're depositing $10 in the bank, right?
Yeah.
Where does that $10 go?
It goes.
You sold a toy for $5 and you borrowed $5. Where's the other side? This is 10 over here. How much has to be over here?
10. Oh, 10.
Okay. Where's that 10 going to go? In one spot or two spots?
Two spots. Two.
What spots?
Revenue. Whoever gave.
Revenue. You sold $5.
And expenses. Liability.
Liability. Because you borrowed $5.
Oh.
All right. So that's going to be 79. That's going to be 59. So 79 minus 59 is
20.
10. What? 20. You're better at math than I am.
Yay.
That's 20. Okay, so something changed here, right? It used to be 15.
Yeah. So it's 5 more.
Oh, our revenue now is 15, right?
Yeah.
Our expenses are still 10. Our net income is now 5. So this is 15 and 5. That's 20.
Yay.
So 79 minus 59 is 20. That balances. 5 is the current year net income, which equals our income statement. So sometimes a transaction can just be on the balance sheet. Sometimes it can be split between the balance sheet and the income statement. But everything has to remain in balance. That's how you know if something's right or wrong. It has to equal. Yeah.
What are we doing with this with money? Where's all the dollars?
Yeah, I didn't put the dollar signs. It takes too much time to write them out. All right? So this is very basic accounting. And what we've done is we've learned about the balance sheet, which is a point in time or a period of time.
Yeah.
Which one?
Period in time. Period in time.
A point in time.
What? The other one's a period in time.
This one is overtime. So this could be over several weeks. You made $15, you spent 10, and you made 5. This could be as of today. Now, again, it includes a period of time, sort of.
Mm-hmm.
But as of today, you have $79 in the bank, but you owe me $59. So really, you only have what?
20.
20.
Oh, yay. Yeah.
Now, these kids love Shark Tank. One last question.
Yeah.
What's the first question they ask on Shark Tank?
What are your sales?
What are your sales?
And can I make any money on it?
What are your sales?
15.
15. Can you make any money?
Yes. Yes.
You made $5. All right. So 5 divided by 15 is what? 15 divided by 5 is 3.
3. I don't know.
So 3 goes into that. So you made 33% net profit.
33 1/3%.
That's pretty good. Now, what have you not done yet, though? You have not paid off your loan. So what happens is some people will show up and go, I want you to pay me $15 for my business because I sold $15 worth of stuff. And the sharks go, no. $5. I don't care what you sold. I want to know what you made, right? The other problem is they say, well, you got to pay me for this $79 in the bank because you're going to get that $79. And they go, no. You still owe someone $59. So really, you only have $20 in the bank.
Mm-hmm.
Now, you could pay this off, which would leave you with 20 and 0. Now you have $20.
Mm-hmm.
And if you want to close the business, this year you made 5. But remember, you had 15 of retained earnings from previous years.
So in all you made.
So if you close the business, you can take the $20. It's yours now.
Yay.
Or you can take it out and take it now anyway, but you need to leave enough money to continue to run the business.
Yeah,
right?
To retain it.
There you go.
Maintain it.
I think you guys understand it better than you did before.
Yep.
Balance sheet, income statement, they interact together. Double entry accounting means balance transactions. Put something here, got to put it somewhere else, and blah, blah, blah. All right. My name's Brad. I'm with Wooten CPA. My goal is to bring peace to your finance and tax responsibilities. One of the ways I do that is through these YouTube videos. Please subscribe to the channel, hit the like button on this video, and don't forget to hit that bell so you're notified when new videos come out. Thank you for watching.